Welcome back. Today we're getting into something that, well, if you're like me, it's probably caused you a bit of anxiety.
Oh, definitely.
Yeah. We spend a lot of time breaking down complex systems for you guys, and you're a savvy audience. You know what a small cap is. You get how REITs or bonds work. But there's this lingering feeling that the pros, the guys in the custom suits, have some secret playbook.
Right, like you're playing checkers and they're playing 3D chess. We just naturally assume there's some massive level of sophistication justifying their huge salaries.
Exactly. And that feeling makes us just want to hand over the keys. We think, I'm not an expert, so I'll just hire someone. But our mission today is to challenge that blind trust. We're diving into some fascinating research on the myth of financial expertise.
And the core argument here is pretty brutal. We are taught to trust experts, right? If you hire a pilot, the plane lands. If you hire a surgeon, they fix your heart. But in finance, the data shows expertise actually doesn't correlate with results.
Which is wild. So we're going to cover why market timing destroys your wealth, the sheer mathematical danger of fees, and why the best person to manage your money is, well, it's actually you.
But to really get Wall Street, the research starts somewhere totally unexpected, a wine tasting.
Oh, yeah, I love this one.
It's a classic psychology study. So they gather 57 recognized wine experts, not just casual drinkers, I mean credentialed professionals.
Right.
They give them 2 wines to evaluate, 1 red, 1 white.
Seems pretty standard.
Yeah, so they swirl it, sniff it, do the whole routine. For the red wine, they write down words like intense, deep, spicy.
Which makes sense for a red.
And for the white, they describe it as lively, floral, citrusy. But here's the twist. They were actually drinking the exact same wine.
Wait, really? Red wine has totally different tannins? How could 57 experts miss that?
The red wine was literally just the white wine with odorless, tasteless food coloring.
That's humiliating.
It really is. But it shows how easily our brains are hacked. We confuse presentation with reality. Their eyes saw red, so their brains expected an intense flavor.
So mapping that to the financial world, we see the mahogany desk, the CNBC appearances, the jargon.
That's the food coloring.
Exactly. That's the perfect analogy. We see the confident presentation and assume there will be deep, intense results. But when you strip away the marketing, the expert product is often worse than just a basic index fund.
Let's talk about those confident presentations. You turn on the TV, and there are pundits constantly predicting what interest rates will do or where oil prices are going.
And our source material argues that those predictions are basically useless. The economy is a highly complex adaptive system. No one can consistently predict the future.
But the media just amplifies the noise.
Right. It swings from euphoria to doom, and these experts are rarely held accountable when they're wrong. But the real issue is that fund managers feel pressure to act on these predictions.
They have to look busy. Exactly. If you're paying them a high fee, they can't just sit there, so they trade constantly. But all that activity just generates trading fees and huge tax bills for the investor.
Activity is the enemy of returns.
You nailed it. Despite their high compensation, active fund managers fail to beat the market about 75% of the time.
75%.
Yeah. Imagine paying a premium for a service that fails 3 out of 4 times.
But, okay, let me play devil's advocate. What about the hot hand? You hear about that one manager who returns 80% in a single year.
It's the fallacy of past performance. The data proves that a manager who beats the market one year actually has less than a coin flip's chance of doing it the next year.
Wow. So it's mostly luck.
It's regression to the mean.
The source had a great example about this. Over a recent decade, if you had to guess the best performing stock, you'd probably say Google or maybe Apple, right?
You think tech, yeah.
It was Domino's Pizza.
Selling pepperoni pizzas beat out high-tech innovation. It just proves that guessing the winners is virtually impossible.
Which brings us to the next trap timing the market. People think, I'll just pull my money out before a crash and buy back in later.
Which is mathematically disastrous. Let's look at the S&P 500 data over a 15-year period. If you just stayed invested, the do-nothing strategy, you averaged about a 7.7% annual return.
That's solid growth.
But if you tried to time it, and missed just the 10 best days in that entire 15 years, your return drops to under 3%.
Just 10 days out of 15 years.
Just 10 days. And if you missed the 30 best days, you actually would have lost money.
That's terrifying. Why is that?
Because the market's best days almost always happen right after its worst days. If you panic and sell, you miss the rebound. Time in the market always beats timing the market.
Okay, but if the industry fails to beat the market 75% of the time, how do they hide that failure?
Survivorship bias.
Ah.
The industry actively manipulates perception. Say a firm launches 100 funds.
Yeah.
After a few years, 50 of them do terribly. They don't just leave them there. They quietly close or merge those failing funds and erase them from the history books.
So when I look at a list of their top funds,
You're only seeing the survivors. It's an illusion. It's called incubator funds. They launch a bunch, see which ones get lucky, and only market the winners.
and people fall into the rating trap, they see a 5-star rating and think it's a sure thing.
But those ratings only reflect past performance, which we already established doesn't predict the future.
Right. But what about the extreme outliers? Like Warren Buffett.
Sure, legendary investors exist, but they have billions in capital and access to private deals you and I will never see. Trying to copy them is dangerous.
It reminds me of the email scammer analogy from our research. This really exposes the probability scam.
Oh, break that down for them.
So a scammer emails 10,000 people. He tells half of them a stock is going up and the other half it's going down.
Right.
The next week, he takes the 5,000 he was right about and splits them again. He just keeps repeating this process.
Right.
Eventually, a small group has seen him make 5 correct predictions in a row.
And to them, he looks like a genius. But it was pure chance. In a market with thousands of managers, someone is bound to flip heads 5 times in a row. It's probability, not expertise.
Exactly. So this leads us to the big question for you, listening right now. Do you actually need a financial advisor?
According to the research, most young people with relatively straightforward finances simply do not. An automatic, simple system works best.
But if you do get one, there's a massive difference you have to know about. The fiduciary duty.
This is critical. A standard broker is just a salesperson. They work on commission and only have to meet a suitability standard.
Meaning they can sell you an expensive product just to get a bigger cut.
Exactly. A fiduciary, on the other hand, is legally required to act in your best interest.
But even then, let's talk about the tyranny of fees. An advisor might say they only charge a 1% fee. That sounds like nothing.
But the math is staggering. Over your investing lifetime, a 1% fee can reduce your total returns by about 30%.
30% of your wealth, gone.
And a 2% fee, that can reduce your potential returns by over 60%.
Which is why the active versus passive debate is so important. Active management is humans guessing stocks with high fees.
While passive management is just computers matching an index like the S&P 500 in the US or the FTSE in the UK or the DAX in Europe, very low fees.
Passive funds are mathematically superior for the vast majority of people simply because they avoid those profit-eating fees.
Exactly.
All right, let's quickly summarize what we've covered today because it was a lot.
We started with the wine pasting experiment, proving that confident presentation often masks identical or worse results.
Then we talked about the futility of pundits and how past performance is mostly luck.
We proved mathematically that trying to time the market can cost you your entire return if you miss just a few of the best days.
We exposed how the industry uses survivorship bias to hide their failures.
And finally, we broke down how a seemingly tiny 1 or 2% fee can devour over half of your lifetime wealth, making low-cost, passive index funds the clear winner worldwide.
It's quite an aha moment. Admitting you aren't an expert and just using a passive approach is actually the ultimate expert move.
I want to leave everyone with this thought. The financial industry literally relies on your insecurity to make money. Every time you doubt yourself and pay for their help, you're making them rich. Walking away from that system might be the most profitable decision you'll ever make.
So true. Thank you so much. If you found this valuable, please make sure to like, subscribe, and share this with someone who needs to hear it. It really helps support our educational discussions.
See you next time.
Take care, everyone.